There is a quite solid argument that Bitcoin or crypto in general works like a pyramid scheme, that it needs new people coming into the space for the price to go up, and that the new issuance that hits the market every day long term depresses the price. So currently we've got an inflation rate of 0.85%. So that means every year we need to see an additional $14.7 billion of new inflows into Bitcoin just to keep the current price. And so the argument is, if the pyramid scheme doesn't continue growing at least this rate, the 14.7 billion a year, then the whole system might collapse. So that's how much we have to expand annually. And here is how much we have to expand every single day. We need to see inflows into Bitcoin worth roughly $40 million at current prices. Now, there is a flaw in this argument. I'd argue that it needs $0 for the Bitcoin price just to stay stable. And that's because the circulating supply is not 100% available. There is Bitcoin that gets lost every year. Have a look at the Bitcoin that has not moved for the last 10 years. Sometimes the very old Bitcoin does get revived. We have seen this in May of last year or in July of this year. But it very much seems like in aggregate, this curve is going up over time. And over the course of the last 3 years, this went from 14% of the supply, a bit less than that, to currently 17% of the supply. So more than 1% of the entire Bitcoin supply seems to get lost every year. So the expansion of the Bitcoin supply through the Bitcoin mining might already be slower compared to the rate at which Bitcoin gets lost. And yes, after the halving in 2018, when the circulating supply expansion will go to 0.4%, this might even improve. The rate at which Bitcoin gets lost might also go down because now more and more Bitcoin is held by institutions and they might on average custody their Bitcoin safer. Still, I'd argue it does not need those 40 million for Bitcoin's price just to stay where it is. It might need $0, or potentially we might have shrinking circulating supply. If we work with the assumption that the rate at which Bitcoin gets lost is the same rate at which it gets mined, then our minimum long-term return expectation should be the debasement of the US dollar, right? 6.8%. This is how quickly USM2 expands over time. This is official Federal Reserve data. Over the course of 66 years, the monetary base has grown by 77x. That's an annual growth of 6.8%. So if the US dollar grows by that rate, but the number of Bitcoin stays 100% flat, that's how much minimum return expectation I believe is rational. Now, when I say minimum return expectation, what could be drivers for potentially more return? Usually those drivers are long-term adoption by investors that tend to just buy and accumulate, and they tend not to sell. It's the idea of Bitcoin becoming another part of a portfolio that's just allocation. What we see over here, that's the number of Bitcoin that's held through the Bitcoin ETFs. It's almost monotonically increasing. So more and more Bitcoin is scooped up by the ETFs. We are looking at 1.5 million over the course of 6 years. More than half of that happened over the last 2 years. So this seems to even accelerate over time. We currently have 20 million of circulating Bitcoin. 1.5 million is 7.5% of the entire supply. Over the course of 6 years, that means an additional supply contraction of 1.3% per annum. Now, this is assuming that the number of Bitcoin held by the ETFs will continue to expand, that this trend will continue. Now, this is not as safe of an assumption compared to the Bitcoin that hasn't moved for the last 10 years to always go up. Right? Bitcoin that gets lost can't be moved. Bitcoin that's bought via the ETFs can potentially get sold. So this is a bit more of a speculative take on Bitcoin's long-term price development. Now, when the long-term trends are so clear, when Bitcoin has to go up versus the US dollar over time, why do we even see those massive bear markets? Why can even Bitcoin drop by 60, 70, 80%? I believe the answer lies in profit taking by the people that have bought Bitcoin for much lower prices. Because let's say Bitcoin makes a 10x over many, many years. And you started out with, say, a portfolio allocation of 5%. Suddenly, after the rally, you've got 50% in Bitcoin. Maybe at that point, you want to rebalance the portfolio again. Maybe not back to 5%, but maybe to 10 or 15%. So there is the chance for the people that have already made a lot of unrealized gains to actually realize those gains and potentially diversify the portfolio more. That effect is still very, very strong. Here is the ETF change over time. And here, this is the Bitcoin issuance. So the ETFs are already buying up on average more than is getting issued. There are some periods where they're selling, but in general, the ETFs are already making up for the current Bitcoin mining rate. By the way, if this is not your very first time watching this channel, then feel free to subscribe over here. I publish videos regularly, and when you're subscribed, YouTube is more likely to recommend the videos of this channel again. But really, what causes all of that volatility is profit taking. Have a look at the long-term holder supply change. We still have our ETF moves here in green, but the long-term holders, they really have much more impact on what's happening. As in, when they are selling, the current rally tends to stop. When they are buying, we tend to see a dip. And since they are currently selling, we see not so positive price action. It's becoming more and more important to actually track what the long-term holders are doing, to actually track how much unrealized profit and loss is there in the market. The average cost basis of the entire market is currently at $56,210. The average cost basis of the long-term holders is lower. It's at $37,600. So the long-term holder cost basis tends to increase a bit slower compared to the general market, which makes sense. The average market participant is still in profit, and historically it was the best time to buy when the average market participant was in losses. That was true after Silk Road and Mt. Gox. That was true after the miner collapse when we had the ICO boom. That was true during COVID. That was also true after FTX and Three Arrows Capital. And since Bitcoin hit 73K, we actually see how the market is slowing down. So the long-term holders are taking profit faster than the Bitcoin price appreciated. It looks like from cycle to cycle, we see less and less net unrealized profit until people realize that profit. We can also see how the volatility to the downside tends to decline. So the next bear market is likely going to be slightly less severe compared to 2022. We can also have a look at the percent of addresses that are currently in profit versus in loss. And there seems to be a very interesting structure here as well, right? When we hit all-time highs, then of course all addresses are in profit. But once we get into a bear market, more and more addresses get out of the profit zone, and it's only the very early investors that are still in profit. There seems to be a flaw here, as in there are more and more long-term investors over time. The short-term investors, they get wrecked with every bear market, and that cohort seems to not grow. But the long-term investor cohort, it does grow over time. Bitcoin does become more and more of a traditional asset class to just allocate towards. This statistic again gives us the hint that we might not have seen the worst just yet. At least we are not at historically low prices yet. We can look at the inverse as well, the percent of addresses in losses. Again, once around 40% of addresses are in losses, we might see a turnaround. Currently, only 20% of Bitcoin addresses are in losses. 80% are still in gains. If you are part of the 20% that are in losses, then you probably have too short of a time horizon. Then you probably bet too much on altcoins, and you probably just hoped for the lottery ticket. It's better to have a rather long-term time horizon. It's better to play the market structure. Not necessarily to find the next 10 or 100x investment, but to just long-term allocate towards the asset class and potentially buy more when we are really depressed. When nobody wants to invest into crypto, when something systematic has blown up, that's when we want to buy. We are not there yet. That's one of the reasons why I've renamed this channel, right? From Gerhard to Berhard. I am heavily hedged. I currently make money in case we fall further. I don't have a crystal ball. I'm simply just interpreting the data as I see it. And I don't think that those patterns are just coincidence. It's very hard to value Bitcoin. Bitcoin doesn't have any cash flows. So really, everybody looks at their Bitcoin investment relative to at what price they bought it. And if that's then portfolio rebalancing, or if that's just apathy and nobody looks at the markets anymore, when everybody is in losses and everybody is just waiting for the recovery, there's probably many psychological reasons why we turn around when the market on average is in losses. But it's mainly psychology. It's not necessarily something fundamental going on here. That's at least what I believe. That's at least how I personally approach the market. There's a good chance that your portfolio unfortunately looks like this. There's a reason for that. The altcoin market got crushed this year. And it was all those influencers that get money from those projects to sell you those altcoins. That's why you are in losses. The fundamental problem is the conflict of interest. The influencers get money, they talk positively about a project, but they might not even invest in that project themselves. They maybe get a token allocation that they then afterwards sell. I've not seen a single influencer on YouTube that's actually willing to share their own data, that's willing to share how they are trading, how they are outperforming just buying and holding Bitcoin. Because obviously the vast majority of altcoins does not outperform Bitcoin. Now I try to be different on this channel. I don't just share my own data of my own trading. I'm getting into the ring, trade for the members of this channel, and everybody can participate. So in July of this year, we started a premium capital pool, and every annual subscriber of the community had the option to invest. And while Bitcoin fell by almost 25%, we made 17% in gains. And it's not just the delta that I like, it's also the very low correlation. As in, when we went sideways, we made money. When we went down, we just lost a little bit. But in general, the strategy has very little correlation. It's very different to the general market where everything goes down, everything goes up at the same time. When prices are going up, it's not that hard to find winners. When prices are going down, it's much harder to generate profit. I want to share the data in a bit more detail. So the average depositor, by the way, we had several millions worth of deposits. The average member deposited 17.6K at the end of the 5-month period. That turned into 20.3K, so an average profit of 2.7K, which equates to 13.4%. Now after a 10% fee, that ends up at 12%. Now 13.4 is different to 17.3 that I showed over here. And that's because a lot of members first waited before depositing. They didn't enter on day one. They first wanted to see how some profit got generated. And because of that delayed exposure to that capital pool, the average return is lower compared to the return if you started on day one. But of course, the real number that matters more is the performance from the very beginning. If we then annualize this, we get to a value of 45% or 40% after fees. If you bought and held Bitcoin during that time, you lost. If you went into the capital pool, you won. If you measure your capital after that 5-month period in BTC, then you'd now have 1.51 BTC after fees. And so those are the kind of numbers I do not see any other influencer sharing, right? Most people just say, buy this token, or I called it right over here and I made it all correct over there. But really, when the rubber hits the road, when it's really about proving oneself against the market and potentially also showing this very transparently to a community, then very few people are willing to do this because it's hard to beat the market. It's much easier to just record videos, keep yapping, pretend to know everything. And while I'm not saying that I know everything, and while I do have bad trades as well, I am at least getting into the ring. I'm at least showing what I'm doing. I'm willing to share whatever success or failure I produce in the market. Now this is just a test of 5 months. Here is my personal trading results over the last 5 years. So this is the monthly alpha over buying and holding Bitcoin. This averages out to 1.6% per month. The dotted line over here, that's the 12-month average. Had I just dollar cost average into Bitcoin, I would have gotten the return by this white gray line. But because of relative valuation trades, because we made money when everybody else was losing, we are able to outperform just buying and holding Bitcoin. That's the hard part, right? We always need a benchmark. When everything goes up and we just take on more risk by buying an altcoin, of course we can outperform. But if things go sideways, if things go down, that's where we can see who's actually swimming naked. When the tide is going down, that's when things get tough. So it seems like you're still around. Even after all of those losses, you still try to learn about crypto, and I applaud you for that. But probably if you haven't made any money in the last year, it's better to change gears. So you can simply just trade whatever I trade actively. So I'm sharing every single trade that I do in real time in premium. That's $125 per month. And because I'm having a good day, I'm sharing one trade here for free. That's actually a premium trade, which is Pudgy Penguins relative to Solana. So you're going short Pudgy Penguins, you go long Solana, and just trading this long-term trend. And if you're making money with that trade, feel free to reinvest this into premium if you don't want to make the jump yet. But Pengo is one of those highly inflating tokens, and it still has a lot of room to fall, especially if the market overall continues to suffer. But then, of course, if you don't want to do the active trading part, you can also join the next premium capital pool where the trades will be executed automatically. This time it will not just be 5 months, but 12 months of trading. There is the manual route. There are several tutorial videos on how to set up all those positions. It explains how to make money when Pudgy Penguins continues to fall, how to have proper risk management in place, and how to execute everything manually. But if you don't want to go the manual route, then instead of subscribing monthly, you can subscribe yearly. Now, currently this is still crossed on the website. This will get updated very soon. The next copy trading vault will launch in January of 2026. And so feel free to join. It's 10 months of premium, right? It's $1,250. You can also just start off with the monthly subscription and then switch over to yearly afterwards. But if you want to start out with yearly directly, again, if we are able to keep the current returns, which of course is a big if, right? Nobody knows if this rate of return will stay. But if this 5-month test is representative of what's going to happen in 2026, then the break-even point for premium with the $1,250 is an investment of roughly $3,000. So you don't necessarily have to go in with 17K, right? Once you go in with a bit over 3K, you already have all of the content for free. And it's not just tutorials, there's also premium updates. There's also various on-chain tools, etc., to help you improve your crypto game. If it's the very first time here, feel free to give this a like. It will help the channel grow. Feel free to also subscribe. I publish videos regularly. There's a link to premium popping up here on the screen. Just click on that. It will lead you to the website. See you next time on YouTube or see you in premium. Cheers.